Yeah, we get a lot of questions, I suppose, on pre-retirement and post-retirement, and I actually say to the client or the individual ask me the question, and it could be any from an employee up to an owner director, and actually there's three parts to pensions. There's pre-retirement, which is you're planning to build a pot, and you have to decide what the pot is going to be, and what the tax implications on it, the tax-free money in that retirement, etc. The post-retirement is when you've retired and you've taken out your tax-free money and you're receiving an annuity, what do you call it, or a guaranteed pension for life, or this AMRF or ARF where you're allowed to take a percentage of the pot and it doesn't die with you. But for me, the most important part is the part in the middle that people actually don't talk about, is at retirement. And when I meet a lot of our clients, for the majority of them, it's the last major financial decision they're going to make in their lifetime, if they have a decent pension pot. And getting that right at retirement is the crucial part, because it could be down to, very simple, your health status. How are you currently health-wise? If you were in very poor health, one of the options would not be the way to go. And I'm not going to get into specifics about, like it becomes a sales process, but it is crucial that the decisions you make at retirement that are best suitable to your needs. And to do that, again, you have to build a proper financial picture with the clients based on where they currently are and where they want to go. So the at retirement part for me is important, very important. But to get to at retirement, the pre-retirement is having the right structure. How much do you want to have a pot to retire on? And realistically, what it comes down to is how much can the client afford? But sometimes they don't understand that the major benefits by pre-retirement, and that comes down to then at retirement, maybe close retirement, your fund actually has to move into a lower risk environment. And again, if you look at markets, if a client said to me, Tony, I'm retiring this year in December, they shouldn't be in the markets. I just wouldn't believe in it, because they want to hold on to what they have. So someone coming very close to retirement, sometimes the best option might be to move them to cash. They might decide they want to play the markets a little bit, or a low risk fund. But again, it's each individual. I can only point out the different scenarios. Let it be the pitfalls or the major benefit if the market went up. But I can tell you from the last 28 years in the business, you're talking to clients at that age, the risk category has dropped, and they're saying, Tony, once we hit retirement, we'd like to know if we had something 6 months ago, that we still have it today. And that's down to having the proper conversation with your clients and what is their risk tolerance, not ours, or not what the financial services industry has a risk tolerance to. It's very bespoke to each individual. So the three parts to pensions for us are paramount. And I said it's pre, at, and then post. Post is you've taken out your tax-free money and you either buy an annuity or you've gone down the road of pension investment vehicle called an AMRF or an ARF, which I say to clients are another word for pensions, but they're an approved minimum retirement fund or an approved retirement fund. If you have pension income of over 12,700, it eliminates the AMRF and you have an ARF. And I suppose that has an investment risk as your pre-retirement versus an annuity. But today annuity rates are very bad value for money. And to put that into context, I suppose, I was lucky enough to join the Ireland Insurance in 1992. And if you had 100,000 of a pension in 1992, you would have got a guaranteed pension at retirement, or income if you want to call it, of approximately 12,000 per annum. If you had 100,000 today, the same pension fund would buy an income of between 3,600 and 4,000. So people said to me, Tony, how could it have changed that dramatically to that? The reason being is deposit rates. But if anyone here is, thankfully, I had a mortgage in 1992, but if you were probably paying anything between 18 and 21%. So that had driven up annuity rates. Interest rates are so low now, you're not getting any return on your money, no matter where you have it. And in some instances, you're getting charged. If you're a company with X amount in your account, you're now paying 0.65% for the bank to hold it. And so deposit rates aren't going to go up, and that's bad news for interest rates as well, or for annuity rates, because interest rates probably are not going to go up in the next number of years, and deposit rates probably will not rise for a minimum of 7 years, particularly with all the debt that's out there, borrowing money to countries. So The post-retirement market is different. You look at if you want to maybe pass assets to your children, your spouse. But again, there's an investment risk in some parts of the post-retirement. But there's an investment risk in buying an annuity as well, because if you were single, for instance, and you had a guarantee of 10 years and you died on your 11, your annuity was finished. You can bill in a spouse's one. So again, it's completely sitting down with a client and having an in-depth discussion of what they want to achieve, but also outlining each scenario. So I'm a firm believer in put all the options on the table and be able to make an informed decision. And without those options, you cannot. And there's a lot of queries coming in at the moment to ourselves on defined benefit schemes. That has become a minefield. I had 3 clients in the last 10 days from a company in Cork, and again, each of them were completely different, but we needed to get everything down on the table and make a proper informed decision. Where when they came to me, there was parts of the jigsaw missing. I told them, unless you give me the rest of it, I cannot give you the advice on this, because I'm going to end up maybe advising incorrectly or not looking at what I call the right scenario for ye. So for me, everything is down to a process that we follow rigorously, and then the advisory part comes in, and that's with the engagement of our clients. And thankfully that has worked very well for us over the last number of years, and we're looking to improve that even further into 2021.